So I lost almost $1,000 on a single trade with Meta stock. Yeah, it hurts, but it's also one of the best learning experiences I've had in a while. Today I want to walk you through exactly what happened, how I set up the trade, what a leap option actually is, why Meta's price dipped right after I entered, and how I still think I can turn this red position into a solid profit by the end of the year. This is not financial advice. All right, let's get into it. And real quick, hit that like button and subscribe so you can follow how this trade plays out. I'll keep updating you in real time. So let's start with the setup. On October 2nd, Meta was trading around 726 per share. I decided to take a long-term bullish bet using what's called a LEAP call option. LEAP stands for Long-Term Equity Anticipation Security, but really it's just a fancy way of saying an option contract that lasts longer than 1 year. It works the same as a regular call option. You pay a premium today for the right to buy the stock at a specific price, called the strike price, before the option expires. But here's why I like LEAPs. They let you control a large amount of stock for a fraction of the cost. In my case, I bought one Meta 670 strike call, expiring on January 15th, 2027. That's more than 2 years of time value, plenty of runway for the stock to move. Each option contract represents 100 shares, so this position controls 100 shares of Meta. The total cost basis was around $16,000. That means the option premium, the price I paid for the right to buy Meta at $670, was about $160 per share, 166 $100 shares, $16,000. At that moment, with Meta trading at 726, the option was already 56 hooks in the money, 726, $670, 56 hooks intrinsic value. So roughly $5,600 of the $16,000 I paid was intrinsic value, and the other $10,000 was time value, the premium for all that remaining time until 2027. Now what happened next is where things got frustrating. Only a few days later, Meta stock started to slide. From 726, it dipped all the way to around $690. That's a 5% move, not a huge crash, but when you hold a leveraged position like an option, small moves can create big swings in your account. That dip dropped the market value of my LEAP from $16,000 to around $14,500, leaving me with a paper loss of about $1,500. Why did Meta pull back? Well, the main reason was OpenAI's launch of Sora 2, its upgraded text-to-video generation model. That release basically sent shockwaves through the entire AI industry. Investors started rotating money into companies that directly benefit from the new wave of AI video generation, like NVIDIA for GPUs and AMD for compute, and away from social media-driven platforms like Meta. Wall Street interpreted the Sora 2 demo as a signal that AI-generated video content might shift the creative landscape faster than expected. For Meta, that raised two big concerns. Number one, the cost of keeping up with AI infrastructure spending, and number two, how much engagement might shift away from Meta's platforms toward new content ecosystems powered by tools like Sora 2. So, for a few days, Meta shares sold off, while NVIDIA, AMD, and even smaller AI plays got all the attention. That short-term sentiment change hit my LEAP option pretty hard. But here's the thing, I didn't panic. Because when you buy a LEAP, you're not betting on what happens this week or next. You're betting on the next few years. And fundamentally, Meta is still one of the strongest AI and ad-driven companies in the world. Their Reality Labs division continues to push the frontier on AI and AR technology, while their core business, Facebook, Instagram, and WhatsApp, keeps printing cash. Meta's profit margins remain impressive, and their share buybacks have been relentless. As of today, Meta's price has bounced back to around $710 per share. That cut my unrealized loss from around $1,500 to roughly $900. So the position's market value is now about $1,100. Now that's still a loss, but it's nothing dramatic. when you consider how much time I still have. My option doesn't expire until January 2027. That's more than 2 years for Meta to move. So let's do some quick math and talk about what happens if Meta really does rebound above $800 by the end of this year. If Meta hits $800, my 670 strike call will be $130 in the money. $800, $670, $130. Since each option represents 100 shares, the intrinsic value would be about $13,000. But remember, because this is a leap, it would still have more than 2 years of time value remaining, and that time value could easily add another $5,000 to $7,000 on top of the intrinsic value, depending on volatility and interest rates. So conservatively, if Meta trades around $800, my option could be worth around $18,000 to $20,000. That means I could go from a $900 unrealized loss to a $2,000 to $4,000 profit without having to buy or sell any shares of Meta directly. And that's the beauty of using leaps. You can magnify gains while keeping capital efficiency high. If Meta climbs just 12% from $710 to $800, my option might gain 20%, 30%, or even more because of that leverage effect. Now, what's my plan going forward? I'm not planning to hold this option all the way until 2027. My target exit is when Meta trades above $800, ideally sometime before the end of this year. That's when I'd likely sell the leap option rather than exercise it. Exercising would require buying 100 shares at $670. That's a $67,000 commitment. Not something I want to do when I can just sell the option and capture the premium gain. If Meta runs faster than expected, say it hits $850 or even $900 on strong earnings or a broader AI rally, the option value could explode to $25,000 or more. In that case, I'd probably lock in profits sooner rather than later. Now, if you're wondering why I didn't just buy Meta stock outright instead of a leap, here's the key reason. Buying 100 shares of Meta at 726 would have cost $72,600. With the leap, I was able to control those same 100 shares for $16,000. Yes, it's riskier because options decay over time, but it's also much more capital efficient. That's how I can take a big position in a name like Meta without tying up too much of my portfolio. Of course, the downside is that volatility hits harder. When the stock dipped from $726 to $690, my loss wasn't just the same 5% drop. It magnified to about 9% in dollar terms. That's the trade-off. But in my opinion, Meta has a great setup for the next 12-18 months. Between AI integration across all platforms, increased ad monetization, and strong user engagement, there's a real chance the stock pushes toward the $800 and $850 range sooner than the market expects. The broader Nasdaq has also been showing strength, and with interest rate cuts expected in 2025, high-growth tech names like Meta tend to benefit first. Combine that macro tailwind with the company's buyback program and margin expansion, and the long-term bullish case is strong. So what's next for this trade? I'll continue to hold, monitor Meta's earnings reports, and watch how investor sentiment shifts post-Sora 2. If Meta's upcoming quarterly numbers surprise to the upside, especially if Reality Labs' losses narrow or Real's revenue accelerates, we could see that push toward $800 much faster than anyone thinks. And if that happens, my leap will go from red to deep green. And I'll be more than happy to post that update here when it happens. Remember, options trading, especially leaps, requires patience. You're buying time. And as long as the company's long-term trajectory stays intact, temporary dips like the one caused by Sora 2 are just noise. So, will I turn this $900 unrealized loss into a profit? We'll find out soon. But one thing's for sure. This trade is far from over. If you enjoyed this breakdown and want to see how it plays out, hit that like button and subscribe right now. I'll keep you posted on whether Meta bounces back and how this leap evolves over time. Thanks for watching, and I'll see you in the next update.